I'm Ben Reppond. Welcome to my YouTube broadcast. Today is August 30, 2023. I begin with a piece that I want to show you, which is the highlight of last year in the financial markets. The highlight last year was the Federal Reserve meeting in Jackson Hole, Wyoming. They call it the Jackson Hole meeting or Jackson Hole conference, and they do it every August. And they bring in the notables and media and so forth, and it's helpful. And then they do make a decision at that meeting. I played this yesterday, so if you watched yesterday's video, you saw this. It's just one video. I played several, but I'm just going to show you one, and it is about 2 minutes long, and it's an interview, and it summarizes the conference. And because I think that was the highlight of last week, I thought this 2-minute clip would be a good summary. And it's an interview that's done by Carl Quintanilla at CNBC with Art Cashin. Art Cashin is a legend on Wall Street. He's been in the New York Stock Exchange for about 60 years, believe it or not. And he's now retired, but they bring him in by a phone interview from time to time, and he still has pearls of wisdom. So in this interview, he said, and Carl Quintanilla also picked it up, was that the comment made by Chairman Powell, which was a great soundbite, and he said, Chairman Powell said, "We are navigating by the stars under cloudy skies." In other words, we really don't, I don't think it's right to say we don't have a clue, but I think it's maybe right to say we don't know, we have confusing indicators and they are not clear. And, but he goes on to say that probably the best indicator for the future is the rate on the 10-year treasuries. And I agree. And if the rates go up from here, they are likely to, but we don't know. And Art Cashin said this. He said, we just don't know. And Chairman Powell wouldn't even be committed to it because they're looking for more data. But if it goes up from here, I will comment, that's not good for the economy and it's not good for stocks and bonds. So take a listen to this 2-minute piece from Art Cashin and Carl Quintanilla.
On the Newsline this morning, Art Cashin joining us with UBS. Art, good to have you. I think the line this morning is navigating under the stars, under cloudy skies. Nice touch there by the Fed chair.
I came across with the same line, Carl. It was absolutely perfect. You know, he didn't say his compass was broke, but he did say it's a tough time navigating, and he didn't want anybody to pick up too strongly. So we are left looking at that yield on the 10-year, which has become all important. We get down below 4.22, and we might get some bids coming into the stock market. We get back up around the 4.35 area. That'll bring out some caution. So it's all about what that yield will be and how we react to what the Fair Chair said, but you're right. He basically said, I'm not exactly sure where we are, but I'm trying to navigate in a very cloudy night.
You know, Art, I believe the last time you were on, you were talking about the S&P's levels and where we were testing roughly between 4,440 and 4,535. Right now we're sitting at about 4,380. Lost some of the earlier gains. What do you make of that in the reaction to Powell?
Well, again, the market is being cautious. It's taking its own pulse and its own temperature. On the S&P, I would watch to see if they get resistance on any rally attempt to get above that 4,400 level. There does seem to be a little bit of mild resistance there. But I would say if I have only one instrument to look at, it's going to be the yield on the 10-year, and I think that will dictate exactly where things are going.
Okay, now I'm going to jump into the dashboard. The beginning one are the 6 equity indexes and the long-term government bond index. This is I show this each week, and in the yellow box in the center, the yellow box shows the rates of return for each of the indexes for the past week, starting with, in this case, the NASDAQ 100 and so forth. At the bottom is the long-term government bond. The ETF is TLT. Over in the next box, the pink box, this is the order that they're in, starting from the highest rate of return this year down to the lowest. And the highest is the NASDAQ 100, and going on down the S&P 500, the developed markets, et cetera. And then the last one, and they're, from 36% down to 2%. And the last one is a long-term government bond, TLT, which is a negative 4.36%. So the and then to the right of that, you see where are these indexes relative to their moving averages, the 20-day, the 50, 100, and 200-day moving averages. And so you can see, because last week was mostly a negative week, that they are all below their 20-day moving average. They're all below, including bonds, all below their 50-day moving average, and then it is mixed on the 100 and 200-day. So in the last 4 weeks, the market has come down. Bonds have continued to stay weak, but the equities have come down, which is why you see so many red dots, meaning below the moving average. I put up above that there are 20 red dots this week. Last week, there were also 20. 4 weeks ago, everything was green except for bonds. All the equities indexes were positive. Now I'm going to show you the sectors within the S&P 500. So again, I do the last week in the yellow box in the center, and I do the year-to-date in the pink box. So you can see the sectors go. The two dominant sectors were technology and consumer discretionary, and then it drops way down to 8%, 4, 2, and then 14/100% for the energy sector, and then 5 sectors are negative for the year. So this is interesting because not exactly, but it's close. A lot of these that are the ones that are positive, like the two most positive, the technology and consumer discretionary, they were at the bottom last year. They were horrible. This year, they're at the top and they're excellent. And the same, the ones that were horrible or they're excellent last year or horrible this year. So it's interesting that things have kind of flipped around literally from one year to the next year. You can see to the right of that, you can see on the red dots, green dots, the 20-day, 50, 100, 200-day moving averages are the dots in columns. The first column is the 20-day moving average. It is every single sector was below its 20-day moving average. All but 2 are below their 50-day moving average. And then when you get to the 100 and 200-day, a number of them have not broken down below those yet. So that's mixed. Some have, some haven't. So I find this interesting. It shows definitely a weakening in the market. This week, there are 30 red dots. Last week, there were 26. Definitely a weakening market when you break it down by sectors. Now, I'm going to show an 18-month, this is an 18-month chart showing the S&P 500. It's a weekly chart showing one move equals 1 week. If it goes up, that's a move up in the S&P 500. And if it goes down, that's, of course, a negative week. I put a black arrow on here to show you the direction, the macro direction of the market. You can see that it does go up and down a lot, but the macro direction is positive from last October for the S&P. And there's a little tick up at the end, and that shows that the S&P was positive for that week. But it's interesting, I just showed you that still the components of that index and the index itself are negative relative to the 20 and 50-day moving averages. So this is it's a positive sign in general, but still there is some weakness in the market because they're below the sectors, and the average itself is below the 20 and 50-day moving average. This is a chart, it's a candlestick chart, and I'm not going to describe or explain candlestick charts, but if you follow candlestick charts, you will understand this. This is the last 4 weeks of the S&P 500, measured by the ETF SPY. So you can see the general direction has been down. So this mirrors what I've been saying in the previous slides. Each move, each candlestick, whether positive or negative, represents a day. So this is a daily chart, not a weekly chart. But I think it tells a little bit of more of a micro story. That's why I added it to the last chart. When you look at the S&P 500, there are growth stocks in the S&P and there are value stocks. Every stock can be put into one of those two categories. There is not a middle category. So when we put those on a relative strength chart, making growth the numerator and value the denominator, we see the following. And there are ETFs, SPY-G and SPY-V, which represent this numerator and denominator. When it goes up, that favors growth. When it goes down, it favors value. You can see last year, the first half of the chart, generally speaking, this is just the last 10 months of last year, you can see that generally speaking, the market went down, and the value during that period of time was in favor because it was going down. However, beginning about January 1, growth came into favor, generally speaking, and is now moving up. There are periods in here this year where certain weeks where value has been in favor, namely the last couple of months it's been in favor, but recently you can see that tick up at the end. That tells you that growth has come back into favor, at least on an intermediate term basis. Small cap versus large cap. When this is a relative strength chart. So when this goes up, it favors large cap. When it goes down, it favors small cap. Which is in favor? Well, it depends if it's going up or down. So recently, since March, you can see this huge direction up in the chart showing that growth that large cap is favored over small cap. Small cap is actually very weak at this point. It's gone up and down, but generally speaking, large cap is favored over small cap. Long-term government bonds, measured by the ETF, measured by TLT, the 20-year government bond, has generally speaking this year been in a declining mode. It is weak. And the reason for that is increasing interest rates and perceived future increases in interest rates. So a little tick up last week, but generally speaking, I put the arrow from last April or from this April, and you can see, generally speaking, it's been in a downward decline. The dollar continues to rally, and it's gone up and down some, but the last few weeks, several weeks, it's been in an upward direction. Gold, for the past few months, has been declining. This last week was positive. Silver has been, it generally follows gold, but because it's exaggerated, it tends to go up more and down more. It doesn't show the patterns as much, but this last week had a huge move up, and you can see that by the move up at the right end of the chart. But since last October, generally speaking, silver has been increasing in value. When I put it on a relative strength chart, because silver outperformed gold this past week, you can see it does go up and down a lot. So this is just kind of a chart that does that. But when it goes up, it favors silver. When it goes down, it favors gold. And we've seen plenty of both. Because silver is moving up more quickly now, you see at the far right of the chart that move in an upward direction favoring silver. Bitcoin has been in a decline recently in the last couple of months, and we have a Bitcoin model, so we've been out of the market and in money market for a while, and sitting back waiting for that next move up. From the beginning of the year through the month of May, it was positive, and then it's pulled back now, and in our investing model, we'll sit back and wait for that to make its next move up. The volatility index has been declining since last October, and you can see this. I put the black arrow on here to show you the level of decline, and even declining this past week. Now, there were sectors in the market, there were indexes in the market that were positive, but mostly there was there were certainly some negative. And the volatility index read that as positive, meaning that the S&P went up, and this is an S&P volatility chart, so volatility index went down. The gold and silver. This last week, you saw from the previous chart, gold and silver both went up. Gold went up 1.3% from the previous Friday, from Friday to Friday, and silver had a huge move up, went up 6.3% in 1 week. And you saw that in the previous chart with that big move up. And the gold-silver ratio is now gold numerator, silver denominator, 79 to 1, favoring the buying of silver is a better value than gold. That's the way it's interpreted. When you buy silver, you can buy it in a lot of ways. You buy it by an ounce or larger quantities if you want. You can buy it by a tube, which is about 20 ounces. And you can buy it by a monster box, which is 500 ounces. The cost of a monster box is $13,280, up from about $12,500 last week. So that big move up in silver has definitely caused the cost of a monster box to go up. This includes the spot price plus the markup of $2.26 for this week, and that makes the cost per round $26.56 when you buy it in quantities of up to 500. Okay, another joke about Jim Cramer and his investing advice or lack thereof. Jim Cramer had an interesting stock idea on CNBC the other day. It's interesting, I looked up Cramer, and on his show, Mad Money, it says that his salary is about $5 million a year. I hope they're not paying him for his investing advice. I think he is paid, and people watch it for the purpose of entertainment. He is a good entertainer. I would give him that. And I'm sure he's made some good moves and buying stocks. But generally speaking, his documented track record is not very impressive. His overall salary, it went on to say, his overall salary at CNBC, because he does other things for CNBC, his overall salary is $12 million. So I guess he's valued, but be careful where you get your investing advice. Thank you for watching. If you have questions or comments, leave them in the comment section below. And I'm grateful to John Kozar for being on the broadcast today.